Welcome to the Opening Bell Report.
If you are keeping an eye on the semiconductor space right now, you know the sector is moving at light speed.
Right.
But every so often, a price action event occurs that makes even the most seasoned algorithmic traders and portfolio managers just stop and stare at their terminals.
Yeah, it's those moments where the models break a little bit.
Exactly. And that is exactly the scenario we are dissecting today. We're pulling our insights from a highly detailed financial analysis report on Marvell technology.
Trading under the ticker MRVL.
MRVL, right. And we're going to answer this, this multi-billion-dollar question. When a stock explodes 18% in a single session, is that just the peak of temporary hype or the absolute beginning of a structural repricing?
It's a massive question.
In fact, we're going to look at why a stock that just shot up nearly 20% might actually be cheaper today than it was yesterday.
Which is an unprecedented setup to analyze, honestly. And that paradox you just mentioned, a stock getting fundamentally cheaper while its share price skyrockets, that is the crux of this entire situation.
Let's lay out the headline data to set the stage for you. Marvell Technology just experienced a historic, violent breakout.
Violent is the right word.
The stock surged 18.35% in a single day, closing at $89.57, and the volume behind this was staggering. We're talking about nearly 90 million shares changing hands.
90 million?
Yeah, that sheer velocity created what the analysis report calls a textbook breakaway gap on the charts.
What's fascinating here is the underlying psychology, and really the sheer capital required to move a stock with Marvell's market cap that aggressively.
Right, this isn't a micro cap.
No, not at all.
Yep.
When 90 million shares cross the tape and drive a price up over 18% in one session, you aren't looking at retail momentum.
Right.
You are witnessing an institutional stampede.
Yeah.
Supply at the previous price levels was completely exhausted.
Just gone.
Gone. The buyers, the large funds they had to aggressively gap the price up just to find willing sellers.
So the mission for us today, and the core thesis we need to evaluate for you, is whether this is just a momentary flash or the launchpad for a sustained run to new all-time highs.
We need to figure out exactly why Wall Street is abruptly recalculating the value of this semiconductor giant.
Right, we need to get past the flashing green numbers on the screen and look at the actual engine of the business. So let's examine the immediate catalyst. The fuse for this explosion was lit by Marvell's fiscal Q4 2026 earnings report.
And saying it beat expectations is, well, it's a vast understatement.
It shattered them.
It shattered them entirely. The hard numbers are undeniable here. Marvell delivered a record top-line revenue of $2.219 billion for the quarter.
Wow.
That is a 22.1% increase year over year. For anyone familiar with hardware cycles, pulling off a 22% jump on a multi-billion-dollar base, especially in this macroeconomic environment, is exceptionally difficult.
But the aggregate revenue only tells a fraction of the story, right?
Exactly. You have to look at the segment breakdown to understand the institutional panic buying.
And that brings us to the data center segment. The analysis points out this is the absolute crown jewel of their portfolio right now.
Precisely. The data center segment alone eclipsed $6 billion for the year.
$6 billion.
Representing a 46% year-over-year growth rate.
That's huge.
It is. This is the segment housing the specific optical and networking technology that feeds the artificial intelligence infrastructure boom. When portfolio managers see 46% growth in the precise sector driving global capital expenditure, they are forced to reallocate.
But I have to push back a little here.
Take away.
Because beating a current quarter is great, but markets are forward-looking mechanisms. An 18% pop on 90 million shares doesn't happen just because you had a good 3 months.
No, it doesn't.
It happens because of the forward guidance. And CEO Matt Murphy dropped some staggering projections in this report. For fiscal year 27, revenue is expected to approach $11 billion.
Which is a 30% year-over-year increase.
Right. And then for fiscal year 28, the guidance leaps to an incredible $15 billion, a 40% year-over-year jump.
If we connect this to the bigger picture, this is where we see a fundamental paradigm shift for Marvell. Historically, if you followed this stock 5 or 10 years ago, Marvell was heavily tethered to legacy telecom and enterprise storage businesses.
And those are tough markets.
Notoriously cyclical industries, subject to brutal inventory corrections. Because of that historical cyclicality, investors have always applied a discount to Marvell's multiple. It was viewed as a boom and bust hardware play.
But this forward guidance signals a complete metamorphosis.
It does.
So the market is finally realizing that the legacy drag is gone. The demand for AI custom silicon has completely taken the steering wheel, and the underlying business model has fundamentally transformed.
Exactly. It is a secular growth story now, not a cyclical one.
Got it.
But to understand if a $15 billion revenue target is actually sustainable, we have to look at the competitive landscape. We all know the heavyweight champion in the room. NVIDIA is the household name, owning the AI training compute space with their GPUs.
Right. Everyone knows NVIDIA.
But Marvell isn't competing with NVIDIA. They are operating in a highly lucrative duopoly for custom AI networking.
We hear this analogy a lot in the analysis report. If NVIDIA is building the ultra-fast sports cars of the AI world, Marvell and its main competitor, the $1.5 trillion behemoth Broadcom, they are building the roads.
The infrastructure.
Right, but let's elevate that for a second. We aren't just talking about asphalt. We are talking about highly specialized optical interconnects and custom ASICs. Without this networking plumbing, those expensive GPU clusters they can't talk to each other.
And if they can't talk to each other, they can't function at scale. Let's unpack why that plumbing is so critical. When you have a cluster of 100,000 GPUs training a foundational model, the bottleneck isn't the compute power anymore.
What is it?
It's the latency of the data moving between the chips. Electrical signals generate too much heat and take too long over physical copper. Marvell's optical interconnects convert those electrical signals into light-firing data across the data center with virtually zero latency.
That's incredible.
And furthermore, they are designing custom ASICs, application-specific integrated circuits. These aren't off-the-shelf chips. These are chips designed hand-in-glove with hyperscalers like AWS or Google for their exact proprietary workloads.
And that custom design process is exactly why it's a duopoly, right? The barriers to entry have to be insurmountable for a startup.
Incredibly high. Developing a 3-nanometer or 5-nanometer custom ASIC requires hundreds of millions of dollars in R&D, years of lead time, and an impeccable track record.
Because you can't afford a mistake.
Right. Hyperscalers cannot afford a chip failure when they are deploying billion-dollar data centers. Therefore, they only trust Broadcom and Marvell. Being one of only 2 trusted vendors for the critical nervous system of the AI revolution puts Marvell in an immensely powerful pricing position.
Okay, here's where it gets really interesting. This brings us back to that paradox I teased at the beginning, what the analysis report calls the valuation anomaly between the 2 players in this duopoly.
Let's hear it.
Let's look at the multiples. Broadcom, the $1.5 trillion titan, sits at a normalized forward PE of roughly 45.6x.
Okay.
Marvell, despite the explosive growth, is sitting at a PE of about 26.6x.
This is perhaps the most actionable insight we can extract here for you. Normally, when a stock surges 18% in a single session, its valuation multiple inflates dramatically because the price jumped overnight while the underlying earnings remain static.
Right, it gets more expensive. But the analysis highlights that Marvell's multiple is actually compressing even as the stock prints new highs.
Yes, because the denominator, the forward earnings projection, is accelerating at a steeper curve than the share price. When Matt Murphy guided for $11 billion and $15 billion over the next 2 years, the consensus earnings estimates had to be aggressively revised upward.
So the earnings are growing faster than the stock price.
Exactly. That future earnings potential is growing faster than the 18% stock surge. What the institutional money is waking up to is that Marvell is a Tier 1 infrastructure necessity, yet it's trading at a massive discount to its peer.
So an institutional investor looks at Broadcom trading at 45 times earnings, looks at Marvell at 26 times earnings, realizes they are operating in the exact same impenetrable duopoly, and decides a structural multiple expansion has to occur.
Marvell simply needs to catch up to the sector average.
Right.
That is the structural repricing. It's not meme stock momentum. It's an arbitrage of valuation within a duopoly.
Okay, but I have to play devil's advocate here for a minute.
Go ahead.
Because hypergrowth narratives often mask a bleeding balance sheet. If Marvell is promising to deliver $15 billion in specialized networking gear, they have to deploy an extraordinary amount of capital to manufacture it. Is this explosive growth burning too much cash?
It's the critical question you have to ask when evaluating hardware companies. But the financials in the report show a definitive profitability flip.
A flip.
Yeah. For years, if you looked at Marvell's GAAP net profit margins, they were frequently negative. However, that was largely an accounting mechanism. They acquired companies like Inphi and Innovium to build this exact AI portfolio, and those acquisitions came with massive amortization and write-down costs that dragged down paper profits.
Oh, I see. It's like looking at a millionaire's bank account the day after they bought a mansion in cash.
That's a great way to put it.
They look technically broke on paper for a minute, but the underlying asset value and wealth generation are huge.
Exactly. The write-downs obscure the cash generation. But this Q4 report stripped that away. They delivered a highly profitable 17.8% GAAP net profit margin, which translates to $396.1 million in actual bottom-line profit. The accounting noise is cleared, and the underlying cash engine is highly lucrative.
Right, but let's look at the operating cash flow margin, because the analysis flags this. Marvell is sitting at 16.8%. Broadcom, on the other hand, boasts operating cash flow margins north of 40%.
Yeah, that's a big gap.
On the surface, if you are an analyst comparing the two, That looks like a glaring operational inefficiency for Marvell. Why is there such a massive disparity?
Well, you can't run a direct apples-to-apples comparison on their aggregate margins because their corporate DNA is structurally different. Broadcom isn't just a semiconductor company. They have a massive, mature enterprise software arm.
Right, they own VMware.
Exactly, they own VMware. Software fundamentally operates with gross margins in the 80 to 90% range, which heavily skews Broadcom's blended cash flow metrics upward.
Because software scales infinitely without raw material costs. But Marvell is a pure-play hardware company. They deal entirely in physical reality.
Precisely. And in physical reality, to meet an $11 billion demand projection for next year, you have to spend hard currency today.
You need materials.
Right. Marvell is aggressively front-loading their R&D budgets. And crucially, they are prepaying TSMC, Taiwan Semiconductor Manufacturing Company, for wafer allocation.
Wait, isn't that a massive risk? Prepaying billions to TSMC?
It sounds like it.
If this AI hypergrowth narrative cools off even slightly, or if hyperscalers adjust their capex downward, aren't they going to be left holding the bag on billions of dollars of prepaid, useless silicon?
It is a risk, but it's a calculated and necessary one given the geopolitical and supply chain realities of the semiconductor industry right now. Fab allocation at TSMC for advanced nodes, the 3-nanometer and 5-nanometer wafers required for these ASICs, is the most scarce commodity on the planet.
Period.
If Marvell doesn't secure that capacity today with cash up front, Apple, NVIDIA, or AMD will take it. Prepaying isn't reckless. It's a defensive mode to ensure they don't bottleneck their own $15 billion revenue pipeline next year.
So the depressed operating cash flow margin isn't cash being burned in operational bloat. It is capital expenditures being aggressively deployed to secure supply.
Exactly.
They are locking down the raw materials to guarantee they can execute on that forward guidance.
It signals a management team highly confident in their backlog of orders, rather than a team just hoping the macroeconomic winds blow in their favor.
That context completely changes how you view the balance sheet. So we've dissected the explosive earnings, the competitive moat of the ASIC duopoly, the valuation gap with Broadcom, and the reality of their capex strategy.
We've covered a lot of ground.
We have. The analysis ultimately synthesizes all of this to render a technical verdict. What is the immediate and long-term trajectory after an 18% breakaway gap?
Well, the technical setup aligns perfectly with the fundamental breakout. That breakaway gap originated from a multi-month consolidation base, right around the $75 level. The stock had essentially been absorbing selling pressure, trading sideways, and building energy.
And then earnings hit.
Once the earnings catalyst hit, it launched. Now, the 50-day and 200-day moving averages are curling sharply upward, providing strong underlying technical support. And again, this is being driven by sustained institutional accumulation.
And Wall Street analysts are scrambling to adjust their models. Price targets from the report that were safely clustered around $90 are now being rapidly ripped up and rewritten into the $110 to $125 window.
The immediate technical hurdle the stock faces is testing its 52-week high, which sits at $102.77.
Okay.
That is the next logical resistance zone where you might see some profit taking.
But the analysis really emphasizes taking the long-term view. It maps out a scenario where Marvell successfully executes its roadmap and achieves $5 or more in earnings per share by fiscal 2028.
Right.
If they hit that $5 EPS mark, today's $89 price tag is going to look like an absolute steal.
It loops right back to the multiple expansion we discussed. If Marvell earns $5 per share and the market decides its duopoly status warrants a multiple closer to Broadcom's, let's say a conservative 35x PE, the math dictates a share price significantly higher than current levels just to maintain equilibrium.
It makes sense.
The fundamental to take away from the data is that Marvell has transitioned from a peripheral hardware supplier into a load-bearing pillar of the global AI build-out.
So what does this all mean? Let's distill this down for you. We started with a violent market-stopping headline, MRVL stock explodes 18%.
Right.
But by aggressively pulling apart the mechanics behind this financial analysis, you now have the structural blueprint of why it happened. You know this isn't a retail-driven meme rally. It is a calculated institutional repricing of a company that shed its legacy cyclicality to become a pure-play AI infrastructure necessity.
From shattering data center estimates to securing a $15 billion forward revenue pipeline.
Exactly. And operating in an impenetrable ASIC duopoly alongside Broadcom. Marvell is securing the scarce TSMC wafer supply today, and the market is finally adjusting their valuation to reflect that reality.
This raises an important question, though, and it's something I want you to genuinely mull over as you watch this sector evolve.
Okay, let's hear it.
We have spent this entire time talking about Marvell building the physical roads, the optical interconnects, and custom ASICs for today's AI workloads.
Right.
But AI architecture is not static. Currently, foundational models are largely processing static text, audio, and images. But as we look over the horizon, as AI transitions into powering fully autonomous algorithmic agents, real-time physical robotics, and predictive systems running entire global supply chains, simultaneously the bandwidth required will multiply by orders of magnitude.
It's going to make today's data requirements look like a dial-up modem.
Precisely. The data shows Marvell is aggressively prepaying TSMC today just to manufacture the silicon required for next year's infrastructure. They're straining to keep pace with the demand for today's roads.
So the question is,
So what happens to infrastructure stalwarts like Marvell or Broadcom when the next evolutionary leap in AI requires entirely new paradigms of data transfer? Perhaps quantum interconnects or photonics technologies that haven't even been successfully commercialized yet.
that's a massive unknown.
Can the physical reality of hardware manufacturing, with its multi-year lead times and billions in capex, possibly keep pace with the limitless exponential ambition of software development?
That is an incredible thought to leave on. Software can ideate a new autonomous future overnight, but a company like Marvell actually has to figure out the physics of building the wider, faster pipes to make it a reality.
And bridging that gap is where the real value is created.
Thank you so much for joining us on this deep dive into the Marvell analysis report. We hope this equipped you with a sharper lens to view these massive market movements. Keep interrogating the data, keep looking past the flashing headlines, and we will see you next time.
Don't forget to like, share, and subscribe for more.